Hello everyone, welcome to the 197th episode of me learning how to trade in Forex. So in the last episode we covered the covered call strategy explained and the vertical debit spread strategy explained. So for the covered call strategy explained, a covered call is made by purchasing 100 shares of stock and selling a call option against it to reduce the cost basis. So taking extrinsic value premium and instantly improving the probability of success. However, there is no longer unlimited profit as it's now capped, but we still benefit from the bullish moves. To create covered call, need 100 shares of long stock. The closer to the stock price, the more extrinsic value to be collected when selling an option. Use covered call options in high implied volatility environments. Usually look at call options expiring 30% in the money and 70% out of the money and adjust from there. So if wanting to collect more profits, the call option could be slid closer to the stock price. If wanting to give shares more upside room, the call option could be slid further out of the money. So max profit for a covered call option, short call strike plus the short call premium minus the stock purchase price. Max loss for a covered call option, stock purchase price minus the short call premium. We normally aim for a 50% max profit, 50% of the max profits. The more profit we see, the less additional profit to be made, so the more risk we hold when the position is open, as everything could be lost. Remember to manage your risk rewards even when profiting. Keep an eye on the short call value. If the stock price is stagnant or drops a little, ensure the short call option doesn't lose too much value as it caps the upside profit potential. So can consider buying the short call option back, move it down a few strike prices or moving it out in time to increase the extrinsic value collected, which reduces the risk. Upside risk is covered in a short call option by the long 100 shares of stock. Covered call options reduce the cost basis of the stock. Covered call options are high probability trades as profits can be made if the stock price doesn't move or goes down a little bit. Covered calls have a downside risk as 100 shares of stock are not fully protected by the short call option. Break even is equal to stock purchase price minus the short call option premium. And then we've got the vertical debit spread strategy explained. So the vertical debit spread is a defined risk vertical spread where the long option purchase is more expensive than the short option sold. So the spread is vertical when the two options have the same expiration cycle. In a debit spread, the long option is the asset and the short option is sold to reduce the cost basis for the long option. So we aim for the asset or stock price to increase in value, so we can sell a call option against the long call option to reduce the cost basis of the long option. This caps the upside profit potential as the exposure to 100 shares of long stock in a long call option is offset by the exposure to the short stock in a short call option. This results in profitability even if the stock price doesn't move. So when eliminating the need for a directional move, the probability of success increases dramatically. In the vertical put spread, the long put option is the asset and the short put reduces the cost basis of the long put. In a covered put option, the short shares are the asset and the short put reduces the cost basis of the shares. For a debit spread, the risk is defined up front, so the debit paid to purchase the debit spread is the maximum potential loss. Therefore, investors with smaller accounts may trade a debit spread over a covered call or put. Debit spreads are generally low probability directional trades that depend on a directional move to be profitable. Anytime max profit is capped and cost basis is reduced, it becomes a much higher probability trade and a lower max potential loss. Further out of the money debit spread is, the lower the chances of success. Still need a movement in the stock price or for out of the money options and at the money spreads to be profitable at expiration, since the spread needs to be worth more than it was bought for. The less extrinsic value paid in the long-term option, the better the chances of success as it minimizes the extra value paid to own the contract. Maximize the extrinsic value collected in the short option. For the long put spread, minimize extrinsic value in the long option and maximize extrinsic value in the short option. The asset in the vertical debit spread is the long option. Short option reduces the cost basis of the long option. Max profit is the width of the spread minus the debit paid, and the max loss is the debit paid to open the trade. Further out of the money with the long debit spread, the lower the probability of success. So that's a summary of what we went through last lesson. Now we're on to vertical credit spread strategy explained. So vertical spread strategy explained. Right, okay, vertical credit spread strategy explained.
In the previous section, you learned about vertical debit spreads and how the long option is the asset and the short option is sold to reduce the cost basis of the long option purchased. In this video, you'll learn about vertical credit spreads and how these spreads differ from debit spreads. Let's quickly review call debit spreads. As you can see, the long option is the asset in a call debit spread. We want that option to increase in value so that we can sell the spread for more than what we bought it for. This is achieved through a bullish movement in the stock price, moving our spread completely in the money. Let's flip the spread on its head and see how a credit spread compares. In a vertical call credit spread,
In a vertical call credit spread,
the short option is the asset.
the short option is the asset.
We are selling this option and we want it to expire out of the money so that the credit
So want to sell the asset
to expire out of the money so that the money. Let's flip the spread on its head and see how a credit spread compares. In a vertical call credit spread, the short option is the asset. We are selling this option and we want it to
So I want to sell the option to
expire out of the money
expire out of the money
so that the credit we collected up front is
so the credit collected
transformed into profit.
can be transformed into profit.
In a credit spread, we're collecting more in the short option than what we're paying for in our long option. This is why the trade is routed for a credit.
Wait
In a
second.
debit spread, we're paying more for the long option than what we're paying, so that the credit we collected up front is transformed into profit. In a credit spread, we're
In a credit spread,
collecting more in the short option than
collecting more in the short option than the long option,
what we're paying for in our long option.
than what is being paid, than what is than what you pay for the long option.
This is why the trade is routed for a credit. In a debit spread, we're paying more for the long option.
In a debit spread, paying more for the long option
Than what we're collecting in the short option
than what is collected from the short option.
to reduce our cost basis. The big difference in a credit spread is the long option and what we use it for. With debit spreads, our long option is the asset.
In a debit spread, the long option is the asset.
With credit spreads, our
In a credit spread,
long option is our insurance.
the long option is the insurance.
When we sell an option, we take on an undefined amount of risk. If we buy an option on a further out of the money strike though, we define our risk at that strike price. Credit spreads offer a high probability of success because we still have so many ways to be successful, but they offer a lower credit than if I would have just sold the option by itself. The trade-off here is that I know my risk on entry and I can adjust it to my risk tolerance. So, how does this insurance contract work? Why is my risk defined? Let's break it down from the perspective of being long or short shares of stock. This image should look very familiar to you, and hopefully it makes more sense at this point. If I buy a call, which gives me the right to buy 100 shares at the strike price, and it's in the money at expiration, it will turn into 100 long shares of stock. If I sell a call and it's in the money at expiration, it will turn into short shares of stock. Since I know this is true, if I sell a call credit spread, I know that the losses on my short call are capped above my long call, as those losses are completely offset by gains on my long call. Just like trading debit spreads, when I buy and sell the same option type on different strike prices, something will be offset by the other. With call debit spreads, my profit is offset by my short call. With call credit spreads, my loss is offset by my long call. It's as simple as by gains on my long call. Just like trading debit spreads, when I buy and sell the same option type on different strike prices, something will be offset by the other. With call debit spreads,
with call debit spreads,
my profit is offset by my short call.
the profit is offset by the short call option. With call credit spreads,
With call credit spreads, my loss is offset by my
the losses is offset by the long call option.
long call. It's as simple as that. Let's take a look at the put side now. If I buy a put, which gives me the right to sell 100 shares of stock at the strike price, and it's in the money at expiration, it will turn into 100 short shares of stock. If I sell a put and it's in the money at expiration, it will turn into long shares of stock. Since I know this is true, if I sell a put credit spread, I know that my losses are defined below my long put, as the losses on my short put are completely offset by the gains on my long put. Again, when I buy and sell the same option type on different strike prices, something will be offset by the other. With put debit spreads,
With put debit spreads, the loss should be the loss is offset by short call option.
my profit is offset by my
Nope, the profit is offset by the
short put.
short put option. With put credit spreads, the profit is offset by the long put option.
With put credit spreads, my loss is offset by my long put.
The loss, whoops, I forgot about that. The loss is offset by the long put option.
Since a vertical credit spread is a premium selling strategy where we collect a certain value to take on a certain amount of risk, we tend to trade them when implied volatility is high in the underlying.
Tend to trade vertical credit spreads when the implied volatility is high.
Our best case scenario is that the spread expires worthless, or we buy back the spread for less than what we sold it for.
Best case scenario is when the spread expires worthless, did you say?
Spread expires worthless, or we buy. Our best case scenario is that the spread expires worthless,
It's when the spread expires worthless, or
we buy back the spread for
buying back the spread for lower,
less than what we sold it for.
for less than what it was sold for.
The higher the IV is, the more credit we can collect from selling the spread,
The higher the implied volatility, the more credit to be collected when selling the spread.
for less than what we sold it for. The higher the IV is, the more credit we can collect from selling the spread,
when selling the spread.
and the further away we can get from the stock price.
And the further away we can get from the stock price. So we can move away, the further away we can move from the stock price. The further away we can move from the stock price.
Another thing to consider is the cost of the long option that defines our risk. The further we slide the long option out of the money,
The further the long option is out of the money,
the less we pay for our long option protection in
the less the long option costs
both put and call credit spreads, which means we slide the long option out of the money, the less we pay for our long option protection in both put and call credit spreads, which means a higher max potential profit,
which means higher max potential profit,
a higher probability of profit,
a higher probability of profit,
and a better break-even.
and better break-even point.
At the same time, the less we pay for the long protective option, the more the trade will act like a naked option trade, which makes the trade more sensitive to a potential IV contraction as well as time passing.
What? So,
Act like a naked option trade, which makes and a better break even. At the same time, the less we pay for the long protective option,
the less the long option costs, the
more the trade will act like a naked option trade,
the more the trade will act like a naked option trade,
which makes the trade more sensitive to a potential IV contraction,
which makes the trade more sensitive to a potential implied volatility contraction,
as well as time passing.
as well as time passing.
The trade-off to consider is that we're taking on more risk by widening the spread, so we need to ensure we're comfortable with additional risk in exchange for a higher probability trade.
Okay, so
Time
risk
passing.
comes along this.
The trade-off to consider is that we're taking on
However,
more risk by widening the spread,
more risk is taken on as spreads are widened,
so we need to ensure we're comfortable with additional risk in exchange for a higher probability trade. The biggest difference between selling a naked put and selling a put vertical spread is the fact that our risk is defined. We pay to insure the risk on our short put contract, which reduces our net credit received, but ensures that we know our risk at trade entry. The trade is still bullish because just like selling a put, we benefit most when the options expire out of the money,
trade is still bullish, do you say?
but ensures that we know our risk at trade entry. The trade is still bullish.
Trade is still bullish. So this is the put credit spread. Put credit spreads are bullish
Because just like selling a put, we benefit most when the options expire out of the money.
and wants the option to expire out of the money.
The higher the IV environment is, the more premium we can collect and the further away from the stock price we can go. It's important to keep our risk in check when selling anything, so we manage our winning trades at 50% profit. Just like you learned in previous sections, the more profit we see on a trade that is still open, the more we have to lose. Since the most we can make is the credit received, we could be holding a ton of risk for very little additional reward if we don't keep our risk reward in check. Unlike selling a put, we tend to let our losing defined risk trades go. When we know the max loss at trade entry, if the trade goes sour quickly, we might see a loss pretty close to our max loss. In that case, we can only lose a little bit more and we can make the loss we see back and then some. That's one of the nice aspects of defined risk spreads. We know we can only lose so much, and if we're already at max loss, we have nowhere to go but up in terms of potential success. A short call vertical spread is exactly the same in all aspects except for the directional assumption. Since we're selling a call spread now,
Short call credit spreads are
we benefit most if the stock drops. That would reduce the value of the spread, increase our probability of success, and move our strikes further out of the money. For these reasons, a short call vertical spread is a bearish trade. Let's review. With credit spreads, the short option is the asset and holds the key to profitability. The long option is purchased to define our risk and is essentially an insurance contract for our short option's risk potential.
In vertical credit spreads, the short option is the asset, the long option is an insurance contract for the short option and defines the trade risk.
Our max potential profit is simply the credit received at trade entry and is realized if the strikes expire out of the money.
So max profit on a credit spread is the credit received
And is realized if the strikes exceeds risk potential. Our max potential profit is simply the credit received at trade entry and is realized if the strikes expire out of the money.
and is realized if the strikes
expire out of the money.
if the strike price expires out of the money.
The max loss is always defined on a credit spread and can be calculated by taking the width between the strikes and subtracting the credit received.
Max loss is defined on credit spreads as the width of the spread minus credit received on trade entry.
Congratulations! You've made it to the end of the basic strategy section and you should be proud of yourself. At this point, you should be able to talk a little bit about these concepts you've learned with friends and family that have absolutely no idea what you're talking about. This can only make you sound smarter, right? You're welcome. Don't forget to take the quiz and I'll see you in the next section.
Very cool. Short strangle strategy explained. Short strangle strategy explained.
Welcome back. By now, you know that buying and selling a put on different strikes and buying and selling a call on different strikes can create a debit or credit spread. Now, we're going to expose you to how selling a put and selling a call at the same time changes the landscape of potential profitability. Less is more when it comes to learning about options, so you'll learn about strangles first, which only has two option components, a short out of the money put and a short out of the money call. Once you understand how a strangle works, learning about the rest of the strategies in this section will be a breeze. Okay, so we know that selling a put is a bullish strategy. We want the stock price to be above our short put, so it makes sense that we want the stock to go up. We also know that selling a call is a bearish strategy. We want the stock to be below our short call, so it makes sense that we want the stock to go down. If we sell both at the same time, we now have a neutral range of profitability. Instead of taking risk on just one side of the trade, we take risk on both sides, which increases our total credit and potential return on capital.
Stock price, okay, selling two out of the money options to create a profit zone.
As long as this neutral range of profitability. Instead of taking risk on just one side of the trade, we take risk on both sides, which increases our total credit and potential return on capital. As long as the stock price lands between our strikes at the expiration of our options, we keep the total credit received as profit. Because only one of these options can be in the money at any time, these options hedge each other. Let's take a look at how this works, and we'll start to combine some other concepts you've learned so far as well. Let's assume the stock price is between our strikes, and I sell an out-of-the-money put and out-of-the-money call at the same time to create a strangle and a range of profitability. Remember, all of this premium that I collect is extrinsic value. Let's assume the stock price is between our strikes, and I sell an out-of-the-money put and out-of-the-money call at the same time to create a strangle.
Sell two out of the money options to create a profit zone
And a range of profitability. Remember, all of this premium that I collect is extrinsic value that will be $0 at expiration, but the value of these options can and will change as the stock price moves. After a few days, the stock price falls towards my put strike. I might see a loss on my short put if I look at it in isolation, since options that are closer to the stock price have a higher premium value than options that are further away. Since I already sold the option, it might now be worth more than what I sold it for, showing me a loss. At the same time, my short call is now further away from the stock price, and the value of my call option should drop. It may completely hedge the loss I see on my short put, which is a good thing since both of these options are still out of the money. This is the main difference between selling a strangle and just selling a put. We typically see less volatile account fluctuations since our directional exposure is lower. Now, assume the stock price has rebounded and then some, and now we're closer to my short call option. I might be showing a loss on my short call, but I might also see even more profitability on my short put. Some time has passed, so it's not out of the realm of possibility to be profitable overall on the trade at this point, since both options are still out of the money. Let's assume some more time passes, but the stock price takes a hit. My short put might show a loss, but my short call might show an even bigger gain. I could still be profitable here even with all the movement in the stock's price, where if I had just sold the put, I may not be. Now we're at expiration, and the stock price is right between my strikes. This is great because both of my options will expire worthless, and I'll keep the credit I collected up front as profit. As you can see, after we place a trade, we will see fluctuations in our P&L as the stock price moves because the value of the option we sold can and will change. Either way, as long as the stock price is worthless, and I'll keep the credit I collected up front as profit. As you can see, after we place a trade, we will see
trade is placed.
Fluctuations in our P&L.
The profit loss will fluctuate
as the stock price moves because the value
as the stock price moves.
The option we sold can and will change. P&L as the stock price moves because the value of the option we sold can and will change.
And the price of the option, what does it say?
The value of the option we sold, P&L, as the stock price moves because the value of the option we sold can and will change.
Sold can and will change.
Either way, as long as the stock price is between our strikes at expiration, it does.
However, as long as the
stock price is between our strikes at expiration, it will change. Either way, as long as the stock price is between
the
strikes at expiration,
strike prices at expiration,
it doesn't matter what the stock price did to get there.
It doesn't matter what the stock price did to get there.
Our options will expire worthless and will be fully profitable on the trade. Because we're fans of selling premium and not buying premium, we always approach the strangle from the short side. Giving the stock price a range to be successful has a much higher probability of success than if we were to buy a strangle, where we'd need the stock price to swing wildly to the upside or downside so that one of our options has more intrinsic value than what we bought the trade for. When selling a strangle, our assumption is neutral because the directionality of our short options offset each other.
Selling a short strangle, the direction assumption is neutral, so hoping the stock price fluctuates within a range.
A short put is bullish and a short call is bearish, but since we're selling both out of the money at the same time, we create a neutral range of profitability. Just like other premium selling strategies, the strangle seller benefits from an increase in premium and wider standard deviations when IV is high.
When implied volatility is high, the seller benefits from
the money at the same time, we create a neutral range of profitability. Just like other premium selling strategies, the strangle seller benefits from an increase in premium
an increase in premium
and wider standard deviations when IV is high.
Yep. When implied volatility is high, the seller benefits from an increase in premium and wider standard deviations.
The higher the IV is, the further from the stock price we can go.
The higher the implied volatility, the further from the stock price we can go.
When IV is high. The higher the IV is, the further from the stock price we can go while still collecting a decent premium, and we can benefit pretty quickly if IV contracts from that point, as that would mean option prices have dropped. Even though we're taking risk on both sides, our goal with a short strangle doesn't change. When selling any option, we want the option to expire worthless, as we can keep the credit received from opening the trade.
So, max profit for a short strangle is the credit collected
Is profit. For a strangle, this happens when the stock is between our short strikes at expiration. One of the benefits of selling premium strikes at expiration.
Maximum loss undefined, because it could go there, it could go like there, or there, so undefined, unlimited. Profit target 50% of credit received. Yep.
One of the benefits of selling premium on both sides of the stock is that we can use the total credit received to improve our break-evens rather than just one side. Since only one option can be in the money at any time, the credit on the side that is not in the money assists our break-even on the side that may be in the money. For that reason, we can use our total credit from selling both the put and call to determine our break-even on either side.
So,
credit from selling both the
break even for upside is equal to short call strike plus the credit received. Break even for downside equals short put strike minus credit received.
The put and call to determine our break-even on either side. Let's review. A strangle is a neutral strategy because selling a bullish put and a bearish call together creates a range of profitability.
A strangle is a neutral strategy because it combines a bullish short put option and a bearish call short bearish short call option as well. Short call option, bearish short call option, and a bearish short call option. Yep.
From a directionality standpoint, each of these options hedge each other.
Strangles are 100% profitable at expiration if the stock price is anywhere between the short strikes. Strangles are profitable at expiration when the stock price is between the two short strikes.
As long as the stock is between the strikes at expiration, the trade will be 100% profitable as we keep the credit we collected and the options expire worthless. If one of our strikes is in the money at expiration by more than the credit we received, we would see a loss. Our loss is undefined since
Strangles will realize a loss at expiration if the stock price is beyond the break-even point of the in-the-money option.
selling two naked options here, but our break-evens are better than if we had just sold one of these options on either side, since only one side can be in the money at any time. Check out the written content for more information.
Strangles contain undefined risk components. Strangle losses are theoretically unlimited.
On strangles, and get ready to learn about the iron condor, which sounds intimidating, but if you understand how a strangle works, you'll understand how an iron condor works too. Don't believe me? I'll prove it to you in the next section.
Which we will look at now. Short iron condor strategy explained. Short iron condor strategy explained.
When you learned about strangles, you learned that the strategy is really just the combination of a short out-of-the-money put and a short out-of-the-money call sold in the same expiration cycle. Because these options oppose each other from a directional standpoint, they create a range of profitability between the strikes when sold together. A short iron condor is no different, except here we're defining our risk. An iron condor is nothing more than a short strangle with long options that are purchased further out of the money to define our risk.
Right.
Except here we're defining our risk. An iron
condor is
nothing more than a short strangle with long options that are purchased further.
Is a short strangle with long options purchased
out of the money to define our risk.
Define risk.
In other words, an iron condor is nothing more than an out-of-the-money short put credit spread combined with an out-of-the-money short call credit spread sold at the same time and in the same expiration cycle. The long options reduce our credit collected on the trade.
The long options reduce the credit collected on the trade,
since we're paying to insure the risk on the short options, but it's a very similar trade when compared to a strangle nonetheless. The best case scenario with a short iron condor is exactly the same as a short strangle. We want the stock to land between our strikes at
best case scenario for an iron condor is the same as a short strangle.
less. The best case scenario with a short iron condor is exactly the same as
for a short iron condor is the same as a short triangle.
As a short strangle. We want the stock to land.
So want the stock price to land
between our strikes at
between the strike prices
expiration, so all
at expiration.
of our options expire worthless.
All of the option expires worthless.
Let's say if I would have just traded the strangle in this example here, I would have collected $5 from selling the short options, $3 on the put side, and $2 on the call side. If I wanted to define my risk, I could then go out and purchase a put and call contract to insure the risk on my short options. Let's say I go 10 strikes below my short put and purchase a put for $1. At the same time, I go 10 points above my short call and purchase a call for $1. Since I'm paying $2 in total to define my risk, my net credit drops from $5 to $3, but now I know my max loss. Both of these spreads are $10 wide, and I've collected $3 from selling the iron condor, so my max loss is $7 now instead of being undefined. See, I told you that you'd get it. Let's dig a little deeper and break down some characteristics of the iron condor. Just like other premium selling strategies, when selling an iron condor, we don't need to be directionally correct with a...
When selling an iron condor, directional assumption is neutral.
stock price. Giving the stock price a range to be successful has a higher probability of success than if we were to become long or short stock outright, where we'd need the stock to move in our direction to be successful. When selling an iron condor, our assumption is neutral because the directionality of our short spreads offset each other. This is conceptually the same as a strangle, except we have short spreads instead of short naked options. A short put spread is bullish, and a short call spread is bearish, but since we're selling both out of the money at the same time, we create a neutral range of profitability. Iron condor sellers benefit from an increase in premium and wider standard deviations when...
So I think everything is in a high implied volatility environment, isn't it?
Implied volatility is high. Iron condor sellers benefit from an increase in premium and...
Condor sellers benefit from an increase in premium when the implied volatility is high.
And wider standard deviations.
And wider standard deviations when the implied volatility is high.
When implied volatility is high. The higher the IV is, the further from the stock price we can go while still collecting a decent premium.
Okay, what I said before.
We keep our risk in check with iron condors by comparing our credit received to the width of the spread.
Max loss is equal to width of the widest spread minus credit received. Max profit is equal to credit received.
Just like selling options for a few pennies, we don't want to take on risk if we're not getting paid to do so. We usually try to collect around a third of the width of the spread with iron condors, which gives us a risk-reward ratio of around 2 to 1. In a high IV environment, we can move our strikes much further away from the stock price and still achieve this ratio. The max profit on an iron condor is simply the credit received from opening the trade. We want the options to expire worthless, as we can then keep the credit received from opening the trade as profit. For an iron condor, this happens when the stock price is between our short strikes at expiration. One of the benefits of selling premium on both sides of the stock price is that we can use the total credit received to improve our break-evens rather than just one side, since only one spread can be in the stock price is between our short strikes at expiration. One of the benefits of selling premium on both sides...
I'm going to leave this episode here actually. My brain is getting fried right now. I think anymore nothing's going to go into my brain. So in the next video, going to carry on from this, finishing off with the 2:14 mark. So thank you all for watching, and I shall see you all in the next video. Bye bye.